And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. Hope you had a great weekend. Again, it's driving me crazy, this thing with the Trump. Why don't you just go and get this over with? My opinion is that I think he made a big mistake. He should have kept pounding these people into submission, into making an agreement. I think what's going to happen now is that he's going to have a tough time with us making a deal, and you know, we could lose the midterm elections because of gasoline. But anyways, I'm not here to talk about that. But I was watching over the weekend. I go, what's going on? Why don't you just go get it over with? Put the boots on the ground. You got to kill the army. The Revolutionary Guard, they're monsters. They're awful people. You got to get rid of them. They're just crazy stuff. But let's go to what's talking about monsters. Let's listen to this clip right here. These clips about how great earnings are, and it's
over intermediate to long term, earnings have been the driver of equity returns. Earnings will be the driver of market. We think earnings are sort of the mid-teens growth rate into next year.
It's pretty great.
Pretty wonderful. And that earnings does seem to be broadening out. It's not just the classic companies leveraged to AI.
Well, if
go ahead. Looking through this year, this has really been much more of an earnings-led market rather than a valuation-led market. And in that regard, that winds up being healthier and probably more sustainable.
Well, first of all, that's a bunch of nonsense, what you just heard there. Okay, it just yields would be going up, not down. Okay, I mean, they're just lying through their teeth. It's just really unbelievable. So oil, I mean, is collapsing. We're at $108 in May, for God's sake. So now we're at $93. Are you kidding me? And yields, they're dropping for the wrong reasons because, again, consumers, the economy, the consumers are hurting. The economy is slowing. The economy, by slowing, disrupts the institutions. That's where the fear comes in. That's why they go out and they buy millions and millions and millions, even billions of dollars in 4 strong stocks. Now, these 4 strong stocks, you know them. They manufacture the chip machines. These are the only 4 stocks in the world that have enough liquidity that the institutions, when they don't like what's going on and they get fearful, they can go in and park money in these 4 stocks because they're big enough. And when they buy 500 million, 300 million, the stock hardly moves. But if you did that with GE or you did that with McDonald's, the stock would go 1,200% in one day, disrupt the whole market. So they're parking money. They wouldn't be parking money. And that parking of money is dropping yields down. And normally, that'd be great if the yields were going down for the right reasons. But the yields are not going down for the right reasons. Yields are going down for the wrong reasons. And that's what's upsetting. So when I hear this nonsense like I'm hearing today, it's earnings. No. First of all, as I said, we have, if earnings are great, then they'd be going down for the yields would be going down for the right reasons, right? They'd be, in other words, inflation is one reason. Inflation would be cooling, okay? We know that. We know that oil would be around $80, $75 to $80. That's where it has to be. We know that shelter costs would be dropping, and it's not. Just look at rents. I'm here in Sarasota. You wouldn't believe the rents here. They keep going up. And wages need to come down, need to slow, and they're not. So yields, if they were dropping for the right reasons, then I mean, if they were dropping for the reasons I just stated, okay, the right reasons, that'd be great. Then I'd buy into these earnings they're talking about. But they're going in for the wrong reasons, where the consumer is in big trouble. He has no money. He's slowing. The economy's slowing. Banks are in deep trouble. Just look at the banks. You look at the yield curve. Never mind I should say never mind. But when you look at the credit spread, we're at minus 77. We got to get up to that. That's bad news, okay? So we're at minus 77. Now, remember, the credit spreads only tell us the banks are safe. There's not going to be a 2008 crash. The credit spreads tell us from 0 to 90, we're in a safe zone. We're tight. 90 to 100, we're in the uh-oh zone. And 100 to 150, we're in a very bad zone. Anything could happen. You could have a crash. Right now, we're at minus 77. We got to be at least, okay, at a plus 90. We're at minus 77. But it's okay. I mean, we're still all right. The banks are okay. But we got to talk about the profits of the banks. That's the problem. And the profits of the banks, that's where we have, banks aren't making money right now because the yield curve is not at 150. You got the yield curve at 150. How many times we've heard that? You got the yield curve at 150 for banks to be profitable. But we're not. We're nowhere near that. We're minus right now. And so again, we got to get to 150 for where we are. We're at minus 70 to get to 150. So the banks are making money and they're lending aggressively and boosting the economy, business machinery people can buy for businesses. That's not happening. We gotta have a swing of over 200 basis points to get to plus 150s. So when they say how earnings are great, that's a lie. You don't have a yield curve that is inverted at 44. That's insane. That's an inversion. So don't listen to what they're telling you. So again, the other thing that's interesting is that we now are going to have a new Fed guy, and everybody's excited about that, right? New Fed guy. He's going to cut rates. Well, he better not cut rates. That would be a bad deal. So first of all, think of it this way here. So, as I said, yields are going down for the wrong reasons. Number one, that's terrible. Two, this guy, Warsh, okay, do you know what the consequences would be if he cut rates? It would be terrible. Inflation would explode. And the Fed credibility would totally collapse because we know he was appointed as the new Fed chair to make Trump happy to cut rates. You can't cut rates in this environment. Inflation would explode. And we remember when Volcker came into office, and rates were at 20%. I was in the oil business back then, and I was trading oil. And every time my tankers came in with oil, the bank would send me a notice how much I owed them. I mean, I couldn't believe. Every day, oil's going up, oil's going up. That's what happens if he cuts rates to please Trump. This will be a terrible thing because we'll have a bond rebellion. That's what's going to happen. We'll have a bond rebellion. Now, initially, if he cuts rates, everybody's going to be happy. And we're going to have a pop up, no question about it. But mortgage rates are going to go up, not down, just the opposite what do people think, okay? This is the short-term money, remember, the Fed rate we're talking about. And so, and what will happen is the credit spreads, instead of being tight, will start widening. And we just talked about the credit spreads. And the credit spreads are, they measure the bank's safety. And what would happen is it would show the banks are getting in deeper and deeper and deeper. So the credit spreads would be widening. That'd be terrible. Foreign buyers would dump all our treasuries. They won't want our treasuries. This is what happened when they did this back some years ago. So rate cuts, yeah, cheaper borrowing. Cheaper borrowing equals more spending, we get that. More spending equals more inflation, we get that. And the Fed loses credibility and inflation becomes terrible again. Now, if Warsh doesn't cut, okay, then you got to buy the same tech stocks, those 12 tech stocks. So if Warsh doesn't cut, let's say he doesn't cut rates, he keeps his brain and he doesn't cut, keep buying the same 12 tech stocks, especially the 4 machine makers, okay? The 4 machine makers, because those are the ones where all the money is going, okay? And if you look at the machine makers, I mean, even today, they're doing well again. Let me just put them up here for you. Yeah, it's the machine makers that are holding up this whole stock market. And we have, let's see if I can find these quickly for you. Yeah, CLAC, AMAT, they're all up today. ASML, LRCX, they're all up. That's where you should be. You should be in those stocks. That's where all the money's going. That's where the institutions are going. Institutions are scared to death. They're buying bonds. That forces the treasuries down. And when those treasuries go down, the big boys, the institutions, with their 18 trillion, will go in and buy these same stocks. They do it over and over. The same 4 stocks. That's what they're doing now. And that's why the yield keeps going down. Oh, this is good. The yield's going down. It'd be good if it was going down for the right reasons, but as I just said a little while ago, they're going down for the wrong reasons. But if Warsh doesn't cut and he keeps his head together, then the big institutions are going to bury and hide cash in these rich, low debt, high margin 4 companies. That's what they'll do. So keep buying those companies. That's where the money's going. And what institutions are saying, when you have yields down to 4.47, what are you, nuts? Earnings are great? No, that says the opposite. Earnings aren't great. And institutions are saying, we're nervous about the economy. It's not growing. The one thing that these big institutions who drive the stock market, who fuels the stock market with their $31 trillion, what they're saying right now, we don't trust the economy, we don't trust the stock market, so we're going to put billions of dollars, hide the billions of dollars in these 4 stocks, because they're the only ones who can take our big orders without disturbing the price, where we'll go up to 100%. Now, yields overnight collapsed. Yields oil overnight collapsed. Why? Because the economy's not growing. So there's no demand. The GDP's not growing. And so the bond traders are hiding in these 12 stocks, but specifically these same 4 stocks. When you see oil collapse, that means there's no demand. That means industry doesn't need oil. That means people are driving less. That means that we're in trouble. Not good news. But what the problem is, these same tech stocks go up, and everybody sees them going up. And tonight they'll say that you'll see the S&P will be positive. Nasdaq would be up 485. Wow, isn't that wonderful? Nasdaq's up 485. Yeah, we're in the stocks. Those 4 stocks, we've been in them a long time. That's great. We'll make money, but it's not great for the market. It's not great for the economy. So for 18 months, we've been told the economy is hot. We've been told the consumer is strong, but it wasn't the truth. The economy and the consumer were on life support. That was the truth. They had credit cards, buy now, pay later, savings. They were taking money out of their savings. They had no savings left. They pulled money out of 401k. Okay, big withdrawals out of 401k. We never had so many multiple jobs ever, and they begging and crying for overtime pay. So the illusion was created under Biden, and Trump continued the illusion that everything is great, but it isn't. And we're starting to find that out now with the institutions. Remember, the institutions fuel the stock market. When the institutions, they have all the money. They have 31 trillion. 18 trillion was printed in 2008 by the Fed and gave them that money because the Fed no longer wanted Wall Street to be pushing these stocks up on BS, all BS storytelling from fundamentals. So now you got a pure market. When institutions buy, we can see where the money's going, what stocks they're buying, what stocks they're not buying. They leave a footprint behind. Every morning I go over that with my gang members and students. I show them. We have 3 charts. The one chart's so important in the morning, okay, is our Pro 3 because it shows on the opening, did the stock open up on a high and could it maintain that high until 5 after 10? That's important. Now, if it can hold the high to 5 after 10, that means you could buy that, you could add to your position. But even then, I wait. By 10:35, if that stock opened on a high, held its high from 9:30 to about 10:35, that would tell you you're going to have a great day with that stock. So again, this whole illusion, and it was everything's great. Well, you heard the cut how they're talking about earnings are terrific. No, they're not. Earnings are terrible. They're just terrible, and they're not telling us the truth. I mean, it's a terrible thing because when you keep lying about how well the economy is, small businesses especially, they make decisions, and they're making decisions on wrong information. The economy's strong. Now, Payne from Fox, remember when you have that cut from Payne? I mean, this guy's nuts. I mean, this guy's a bold-faced liar. Listen to what he says.
What do you make of all these numbers? You do this every day.
It's you started off talking about a temperature check. I say sizzling. That's the temperature, sizzling.
Well, let me tell you, that's the boldest lie, and he knows that. Sizzling? How can it be sizzling when the institutions, with their money, fuels the stock market? Nobody else. The stock market is fueled by them. And they're so scared right now because the economy is contracting. We have so much trouble going on that they're scared, and they're buying bonds. So that's a bold-faced lie. Sizzling? Give me a break. And how could it be sizzling? Look at Walmart. Look at Cisco. They're collapsing. What are you, nuts? Sizzling? Have you seen Walmart? Have you seen Cisco on a chart? I mean, Costco? This is nuts. Look, I can put them up for you. This just drives me nuts. It's just unbelievable. So there's Costco, okay, and I'm going to put up Walmart in a second here. Look at this. And they're telling us their earnings are great. Look at this. Look at Costco collapsing. Look at Walmart collapsing. Matter of fact, it's a good short. All those big box stores are collapsing. So how can it be good? It's not. They're lying. They're lying. So when you have Cisco and Walmart, they are the barometer of the consumer, how well he's doing. And they're saying the consumer is doing terrible. Just like yields tells you what's going on with the stock market. And the yields are telling us right now that the stock market is in real trouble. Now, it doesn't mean it's going to correct or going to crash. No, but underneath, or if you look inside the stock market, it's bad shape. But they've been able to hold the stock market up for 18 months with BS. And now they keep funneling more and more money. Who's they? The institutions into the 4 of the 12 stocks which are 70%. Remember, 70% of the S&P profits are 12 stocks. But 4 of those are really holding up the other 8. So again, the institutions right now are buying bonds out of fear. That's what's going on because the consumer's weak. Oil's collapsing, recession, okay, odds are rising, and the Fed, they're not going to cut rates. If they did, it would be a disaster. We just talked about that. So when you have the institutions going in and buying 300 million, 500 million, order after order after order in these 4 stocks, you know what it's telling you? The institutions are telling you, what are you, nuts? Do not trust this market. That's what it tells you. Do not trust the Fed. Do not trust earnings. That's what it tells you when they go and they buy treasuries. But nobody's going to tell you that. I mean, institutions parked $7 billion into ASML, AMAT, LRCX, clock, the 4 companies that make these machines make the machines for chip making machines. 7 billion since Thursday. 7 billion. Now the reason it goes into those 4 companies because they got enough liquid to take that kind of buy order, and the stock's not going to go up 100 or 200%. That's what would happen if you bought McDonald's. They're also purchasing. Earnings are good? How about this then? If earnings are good, then why are the institutions purchasing defensive stocks, ETFs, like IYZ? Why are they purchasing those? Because they know that earnings are bad. So if we didn't have these 4 companies, we'd have another 54% correction, just like in 2008. But that's what's preventing it, these 4 companies. And these 4, we're up 18 months. We should have had a 54% correction again, but we're up 18 months on bad earnings, bad everything. But we can continue to go higher and higher and higher as long as institutions keep parking their money in these 4 stocks, 4 out of 12. So ride them with us. That's what we're doing. We're riding them. We're not selling them. We're not short. We're in there buying them. But we'll know when to get out. That's the other problem. People don't know how to sell short. They don't know when to get out. Look at Enron. We shorted Enron all the way down. Like Jim Cramer was going, buy, 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 buy. Well, that's it for today. Okay, so don't believe what you're hearing from Wall Street or from the jibber jabbers. They're lying. Or from Payne. He's lying, and he knows it. They're all, I mean, Hannity was, you go on with me, and I'll lie, you lie, and I'll stamp it. How's that? You do the lying, and I'll stamp it, give it the approval. All right. I'll see you tomorrow, same time, same place. Hope you join me again. If you're not a gang member, join my gang. It's free for 10 days. See you at the church.